Welcome to the Deep Dive.
Great to be here.
So today we're tackling a really interesting angle on Bitcoin. It comes from a Cointelegraph article. The headline is, Bitcoin now deflationary due to Strategy's BTC purchases analyst.
Yeah, that one definitely caught my eye too. Deflationary isn't the usual word we hear with Bitcoin, is it?
Exactly.
Yeah.
We normally think inflation hedge, store of value. But this analyst suggests one company buying a lot of Bitcoin might actually be causing deflation.
Right. So our mission for this deep dive is basically to unpack that. Like, what's the argument? Does it hold water?
And what does it mean, for the market, for Bitcoin's future?
Precisely. Let's get into it.
Okay, so the analyst is Ki-Young Ju, CEO of CryptoQuant. What's his main point?
Well, the core argument is actually pretty straightforward, conceptually at least. He's saying Strategy, the company formerly known as MicroStrategy,
Right.
they're buying up Bitcoin so fast that the rate they're buying at is actually higher than the rate new Bitcoin is being mined and entering the system.
Higher than the mining rate. Okay. And Strategy's holdings are substantial, aren't they? The article threw out a number.
Oh, absolutely substantial. We're talking 555,000 BTC according to the piece. That's a serious chunk of the available supply.
Definitely. And based on that number alone, Ju calculates a specific deflation rate?
Yeah, he puts a figure on it. He calculates that Strategy's activity by itself translates to an annual deflation rate for Bitcoin of minus 2.23%.
Minus 2.23%. Just for one company's buying.
Exactly. And then he kind of broadens it out, suggesting if you factor in other institutions that are also holding Bitcoin long-term, maybe not selling, the total annual deflation rate could be closer to minus 2.33%.
Okay, that's pretty significant. Now, Strategy, for anyone maybe less familiar, they've basically turned themselves into a Bitcoin treasury company. Michael Saylor is the big name there.
That's right. Saylor, the co-founder, he's become, probably one of the most prominent Bitcoin advocates.
Very vocal, yeah.
Very vocal. And Strategy's whole approach, the strategy, if you will, is just continuous Bitcoin accumulation. But how they do it is also interesting.
What do you mean?
Well, the article points out they act as a sort of bridge, a bridge between traditional finance, or TradFi, and Bitcoin.
How so? Like a gateway for institutional money?
Kind of, yeah. They raise money using traditional methods, issuing corporate debt, selling stock, and then they turn around and use that capital to buy Bitcoin.
Ah, okay. So they're tapping into TradFi markets to fuel their Bitcoin buys.
Exactly. And it seems to be working in terms of attracting traditional investors. The article mentions over 13,000 institutions hold Strategy stock now.
13,000. Wow, so that shows a real link between their stock performance and, indirectly, Bitcoin exposure for these institutions.
It really does. It highlights how Strategy is kind of driving institutional adoption, even if indirectly through their own stock.
And the consequence of all this buying, according to the article, is what? Less Bitcoin available?
Basically, yes. All this consistent buying pressure restricts the freely floating supply of Bitcoin.
And basic economics says less supply, steady or rising demand.
Pushes prices up.
Right.
And there's another potential effect mentioned. It might actually be dampening Bitcoin's volatility.
Really? How would that work?
Well, think about it. If you have this huge, consistent buyer always in the market, it can act like a floor, potentially.
Absorbing selling pressure.
Exactly. It could make the big dips less severe, smoothing things out a bit. It's an interesting idea.
Okay, so to really understand the scale of Strategy's buying versus new supply, the article brings in another voice.
Yeah, Adam Livingston. He wrote The Bitcoin Age and the Great Harvest. And he uses this really evocative analogy.
Kind of synthetic halving. I saw that. What's he mean by that?
So, you know how Bitcoin has these programmed halving events every 4 years or so?
Right, where the reward for miners gets cut in half, slowing down the creation of new coins?
Precisely. It's a built-in supply shock. Livingston is arguing that Strategy's buying is so significant, it's having a similar effect on the available supply as a halving event. They're just taking so much off the market.
So it's like they're artificially creating a supply squeeze, similar to the protocol's own mechanism.
That's the idea. And the numbers cited kind of back this up. Currently, all the Bitcoin miners globally, combined, produce about 450 BTC per day.
Okay, 450 new Bitcoin hitting the market daily from miners.
Roughly, yeah. Now compare that to Strategy's average daily accumulation mentioned in the article, 2,087 BTC.
Whoa, wait, say that again, 2,087.
2,087 per day. on average.
That's more than 4 times what's being mined each day.
Over 4.5 times, yeah.
Yeah.
So you can see why Livingston calls it a synthetic halving. They're absorbing multiples of the new daily supply.
Okay, yeah. That puts it in perspective. No wonder it feels deflationary. And the article also mentioned miner reserves are going down.
According to CryptoQuant data, yeah. There's apparently a declining trend in the amount of Bitcoin held by miners, suggesting they are, selling what they likely to cover costs or take profits.
Which makes sense, but it also means that new supply is hitting the market. It's just being soaked up incredibly fast.
Soaked up and then some by players like Strategy. And importantly, the article stresses Strategy isn't alone here.
Right, it's not just one company. There's broader institutional interest.
Definitely. We're seeing hedge funds getting involved, some pension funds exploring it, asset managers, even a few tech companies adding Bitcoin to their balance sheets.
And their motivations are probably varied.
Sure. Some see it as diversification, an asset that doesn't move perfectly in sync with stocks or bonds.
A hedge, maybe, against inflation.
That's another big one, yeah. Hedging against potential fiat currency devaluation. So you've got this growing institutional demand layer adding to the pressure.
Okay, and then there are the ETFs, the Bitcoin spot ETFs. How do they fit into this picture?
They're another significant factor, according to the article. The consistent inflows of cash into these ETFs, well, that represents more buying pressure.
Because the ETF providers have to go out and buy actual Bitcoin to back the shares they issue.
Exactly. It's fresh capital coming in from traditional financial markets, providing another steady source of demand.
And does that also contribute to the idea of price stabilization or less volatility?
The argument is that it does, yeah. It helps absorb selling pressure, smooths out the bumps. It makes big downturns potentially less severe because there's this constant baseline demand from the ETF inflows. Sort of like a shock absorber, as the article hints.
Right, okay. So multiple demand sources, Strategy, other institutions, ETFs, all squeezing supply. But the article ends on a note about who isn't really in the game yet.
Yeah, the really big fish. Sovereign wealth funds.
The massive state-owned investment fund.
Exactly. And Anthony Scaramucci, founder of Skybridge, he weighs in on this.
What's his take? Why are they holding back?
His view, according to the article, is that it mostly boils down to regulation, or rather, the lack of clear, comprehensive crypto regulation, particularly in the U.S.
So regulatory uncertainty is the main hurdle for them.
That seems to be Scaramucci's perspective. These are huge, often quite conservative entities. They need regulatory clarity before they can make significant moves into a new asset class like Bitcoin.
But he thinks that will change.
He predicts it, yeah. He suggests that once a solid U.S. regulatory framework is in place, that could be the trigger.
The green light for sovereign wealth funds.
Potentially, yes. And if they start buying Bitcoin in size, given the sheer scale of their assets, well, that would likely have a very significant upward impact on price.
Wow. Okay. So let's try and synthesize this. What's the main takeaway from this deep dive?
I think the core idea is pretty compelling. You have at least one major entity, Strategy, buying Bitcoin faster than it's being mined. That creates a real measurable deflationary pressure on the available supply.
Right. And that's amplified by other institutions getting in, plus the steady demand from ETFs.
Exactly. It's a dynamic shift. And the potential arrival of sovereign wealth funds, pending regulatory clarity, adds another layer of, potential future demand pressure.
It really flips the script from just thinking about Bitcoin's programmed scarcity to scarcity driven by active, large-scale accumulation.
It does. It raises fascinating questions about what happens when demand, especially institutional demand, starts consistently outstripping new supply in a digital asset.
Okay, so here's something to leave you thinking about. If this deflationary pressure from institutional buying keeps up, or even accelerates, how does that fundamentally change how we value Bitcoin? What's its role in the global financial system if it becomes an asset class defined not just by its code, but by massive entities constantly reducing its available supply, especially if those sovereign wealth funds jump in?
That's the big question, isn't it? It shifts the whole long-term value proposition, potentially.
Definitely something to watch. Thanks for taking this deep dive with us today.